So we wanted to kind of touch on the first part of the morning and our part, just to kind of touch on tax updates from the bill that was passed late last year and kind of how it's going to impact 2018. And we can also take some questions, and then obviously there'll be lots of time later on for more questions. So, all right. So first pop quiz question: what is the name of the latest tax change? The Tax Reform Act of 2018, the Tax Cut and Jobs Act of 2017, the Tax Reduction and Reconciliation Act of 2018, or the biggest tax cut anyone has ever seen act?
Please raise your hand. This gentleman back here. This gentleman right here.
B is
correct.
B is correct, yes. The Tax Cut and Jobs Act of 2017. So yeah, I don't know, obviously where they come up with these names, nobody ever knows, obviously, but.
And I don't know if you guys knew, but one of the proposed names for the tax cut was going to be the Tax Cut Act. How many of you guys heard that before? This is a true story. I didn't make that up.
Okay, so here's a quick slide. Can you maybe move over a little bit? So, just a quick slide of tax rates now under the new bill. The single brackets are on the left, obviously married is on the right. Essentially, the brackets, they've kind of, overall, they've lowered the rates. They've kept 7 brackets, as you can see. They've also kind of done away with a lot with the marriage penalty. There used to be a marriage penalty where it wasn't, equated equally for single versus married people. So now, now to get to the top tax rate as a married couple, you have to have over $600,000 of income. Before it was like $400,000 of income. So you may, if you go and look at your own, compare last year, 17 to 18 rates, you may see, your rates might have gone down 3 or 4% depending on your income. The other thing to keep in mind here is that it's kind of hard to see maybe the colors, but the bottom 2 here are a very light shade of blue, and then the middle, and then the dark blue. Those relate to capital gains rates. So the capital gains rates themselves have not changed. So it's possible that if you have some income in the 2 lowest brackets, some of your capital gains might be taxed at 0%. And then if your income falls in that middle area, you get, a lot of your capital gains will be at 15%. And then some, if you're on the top, might be at 20%. So the actual numbers related to the capital gains brackets don't coincide exactly with the income brackets, but it's pretty darn close. So, yes. There is still a long-term and short-term. So these are the long-term capital gains rates. Short-term is still taxed at ordinary income rates. Okay, so one of the changes we want to mention was in regards to the tax bill was the mortgage interest and HELOC, and how do we maximize our interest deductions going forward? And right now we're talking about your primary residence. Okay, so keep that in mind. So good news is for those of you who didn't take out any new loans in 2018, nothing has changed for you, okay? But if you are going to take out a new loan on your primary residence, you can deduct interest up to a loan balance of $750,000 only. Before it was like $1 million. So just keep in mind. But again, if you haven't changed your loan on your primary residence, you have $1 million loan from 3 years ago, you can still deduct the interest on the whole $1 million.
And the other changes that starting in 2018, you probably already know, HELOCs are no longer tax deductible for primary homes for the most part. The main thing that Matt touched on, we want to make sure everybody's clear on, is that these new limitations only apply to primary homes. So for those of you who are landlords, you invest in rental properties, flipping properties, the interest and HELOC on those are not limited at all. Okay, so they're still fully deductible against the rental income, regardless of what the loan dollar amount is.
Let's take questions at the end just for make it easy for Aaron and getting everything on the recording, if that's okay. All right, another pop quiz question. So under tax reform, which of the following is true? A, entertainment is no longer tax deductible. B, meals are no longer tax deductible. C, meals and entertainment are both no longer tax deductible. Or D, only meals paid when eating with your CPA are tax deductible.
This gentleman right here? Entertainment is no longer tax deductible. That's great.
Yeah, so what that means is that if you wanted to take your CPA to game 4 or 5 of the World Series, You may not be able to deduct the cost of the tickets, but you could probably deduct the cost of the meals while we're at the game, though. So just keep that in mind.
So one of the things the Irish just came out with this, I think it's a week or two ago. So they said, what if, like in Matt's example, if meals and entertainment occur at the same time, what do you do? The best way to deduct it is to have it separately invoiced or separately listed on the invoice. Okay, so that's how you could still maintain it, because we are getting this question a lot. When you're entertaining your clients or your investors, you're providing food and beverage. So make sure that those are separately listed and you're still good to go on those deductions.
And if there's ever a question of, that you guys live in a great state of California, California doesn't want to conform to anything that the federal came out with. So where entertainment is no longer tax deductible for federal purposes, it actually is for California. So this is why you pay us the big bucks to keep track of all these differences, right? So, or that's why we pay software big bucks so that they can keep track of it.
I mean, for 99% of the time, California has more strict rules than the IRS. When the IRS gives us tax benefits, California takes it away. This is one of those very rare instances where the IRS took it away, but California is still allowing us to do it. So,
Section 199A deduction. So, how many of you guys have heard of the flow-through entity tax break? Got a lot of press. It is probably in my opinion, the best thing that came out of the tax bill. Essentially, what this means is that if you have the right type of income and the right type of business, that you may be able to take 20% of the income from that business to be tax-free. So if you made $100 in that business, you may only have to pay tax on $80 of that 100. Sounds good, right?
I think one of the most common questions we've received this year is whether I need to have a legal entity to take advantage of this tax break. And I think the confusion comes from the media that's referring to it as entity tax break, flow-through entity tax break, business tax break. But the reality is you don't have to have a legal entity in order to take this tax break. It certainly could be available if you have an LLC or a partnership or an S corporation, but that's not a requirement in order for someone to get this tax benefit. Okay, so that's probably one of the number one questions that we receive a lot. Clients calling in saying, gosh, do I need to run out and form an entity because I want to take advantage of this? Okay.
Right.